Launched in 2015, annual S&P 500 dividend futures allowed investors for the first time ever to see what market participants expected would happen to corporate cash flows in the future. Since 2017, there have been 11 annual dividend futures contracts, one for the current year and one for each year in the subsequent decade. S&P 500 dividends grew by 40% in the 90s, another 40% in the 2000s, and then 155% in the 2010s. But pricing for the 2020s has never been so optimistic. Currently, investors price that the most likely scenario for dividends this decade is that they fall by 10% from their 2019 levels and then recover slowly, but that even by 2030, they still won't be back to last year's levels. By contrast, even in February, before the pandemic set in, annual dividend futures priced only a 20% rise in dividends over the course of the 2020s. So what happened? How can stock prices have hit record highs this summer, even as expected dividends growth remains so modest? Well, here's one possible answer. If one sums up the 11 annual dividend futures contracts, one can estimate what investors think is the most likely amount of dividends to be paid over the next decade. You might be surprised to see that the sum of the next 10 years worth of dividends is lower today than it was in 2017, even though the equity market is close to 50% higher. That might seem odd, but it's not too surprising when one remembers that the equity market, in theory, should be discounting future cash flows into present value. When one takes the net present value, or the NPV, of future cash flows, one finds that between the beginning of 2017 and April 2020, the net present value of dividends and stock prices moved in lockstep. How so? It's simple. Bond yields fell. As long-term interest rates fell, that increased the net present value of future cash flows in the equity market, even as their nominal values didn't really change very much. What this tells us is that the equity market's valuations may have already been dependent on long-term interest rates remaining low, even before central banks began a new round of quantitative easing, or QE, this spring. But look what happened next. Since April, equity prices have risen, even as the NPV of dividends has remained relatively stagnant. This may have occurred because of global QE. 5 major central banks, including the U.S. Federal Reserve, expanded their balance sheets by buying bonds. It was at this time that equities began soaring, even as the NPV of dividends stopped advancing. The central banks began to slow their asset purchases over the summer, and equities seem to have lost some of their upward momentum, at least for the moment. And this raises a question for the world's central bankers. Did QE programs cause equities to rise above the value of cash flows? And if so, what will central banks do if equity prices begin to fall back? Will they do further rounds of quantitative easing and risk sending stock prices even higher, even further away from dividends? Or would they allow equity prices to decline, potentially impacting consumer and business confidence? I'm Eric Norland, Senior Economist with the CME Group in London.